Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. It's my line that I always use in the beginning. I've got Scott with us again today. We're going to talk about a little bit different topic. Some people ask me this every once in a while. The question that I'm going to pose to both of us, because we'll both do our sharing here, and maybe we don't have great answers, maybe we don't have answers yet, but we're going to go back and forth here, is if you are a completely new investor and ourselves, Scott would go back in time or I would go back into time and tell myself when I was a new investor that this is what you need to do in order to become successful in today's world with all of the technology, all of the YouTube channels, all of the websites and all this different stuff that we have today to learn from. What would you tell yourself about what you need to know to learn to get ready for this next bull market that's coming up in commodities or whatever the next bull market is? What would you tell yourself? And even myself, I do struggle with this question a little bit because it's like you took all these years to learn all this stuff. How do you fast track that? How would you I mean, what are some things that maybe you would do? Or do you want me to start and just kind of name some off the top of my head?
Yeah, it's a really difficult question because the information, the availability of information back in the 2000s commodity fund definitely wasn't anything like what's available right now. And the only things that I could kind of listen into were like CNN, CNBC, Bloomberg, and occasionally Peter Schiff and Mike Maloney and those type of guys. So I probably relied on them. But the thing with these is I think it's very conflicted. So what I mean by that, they've got conflict of interest. A lot of these big names have conflict of interest in that obviously they sell something that they obviously they want to be promoting the stuff that they want to sell. And obviously CNBC get paid by the big banks and things like that, occasionally they might want to sell certain commodities, for example, and, they might want buyers to step in while they're selling. So it's difficult, but, right now, I think there are, a lot of good independent, and I don't know, like analysts, if you want to call them that. So, I find you great. I mean, one thing is, I think one thing that I would do if I could go back in time, and if I had the same, information available right now as we do right now, then I would actually be looking for, mentor or a tutor, such as yourself. I think that's probably the best thing because, I mean, it's very hard to start off fresh and know as much as someone like yourself, for example, who's had, many years of experience, decades of experience. So I would be looking for someone who can kind of take me along the journey. And I would literally, I'm not just doing it because you're my friend or anything like that, but I would literally, sign up to like, membership with you or something like that, so that I can, because I mean, if you think about the membership, cost of membership, it's nothing compared to what you can save or what you can make. So I mean, I would have loved to have that, a tutor like yourself, if I could go back in time. But obviously we didn't have that available back in my days. I'm old, so we didn't have anything like that available. But that's literally what I would do. Look for a mentor.
Yeah, the thing that I would have told myself back in the day, is don't rely too heavily on some of these like one or two experts. You have to like spread out. And what I've done is I've had to think and cover a lot of gaps myself. And I think I should only pick slices from people. And that's what I've been doing lately. You can't wholeheartedly believe in one or two people. So I mean, I guess what I'm saying is like, so I used to follow Peter Schiff, and I think he's completely great on some things. And then I also followed Mike Maloney. I've probably listened just as much as you have to Mike Maloney and some of these other ones. And he does talk about ratios, and he's very good with the ratio aspect. And a lot of the gold and silver guys and precious metals guys are really good ratio type people. And that's where I learned the ratio stuff. But if you listen to Mike on the housing market, he knows, I mean, like, I think he's way off. Like that's and you basically have to form your own opinion. And your opinion has to be so strong that you can defend that opinion and even to defend it against Mike Maloney and Peter Schiff, because Peter Schiff's been calling $5,000 gold from like 2009. And I'm just like, come on, man, like your timing's off here. Like I agree with everything he says in terms of the economy, in terms of debt, in terms of all that stuff. But I mean, give me a break. The $5,000 gold thing since 2009, something's wrong with the thesis that he has, and he just never like tested. Same with Harry Dent. Harry Dent, what he opened me up to is the demographic portion of it. And I'm like, oh, that's right. Demographics is running some of this stuff. So then I looked at the demographics, tied it to real estate, and then I tied real estate, the cycle, and overlaid it with all the other financial stuff. And I'm like, there's a clear connection here. So the problem I have is if I go back, there's no one that's necessarily like me that did this, because I had to like literally forge through new stuff, because I found a bunch of people that said XYZ. Then I found that XYZ was not right. Like they would, X was right, but Y was not right. And Z was just completely off. So I'm like, something's wrong with whatever they're trying to tell me. And I just picked it apart on all these different people. But I picked something from everyone and then combined it all. So I can't take credit for everything that I came up with. But I mean, if you're
that's
new
exactly
and you don't
what I've been doing. Yeah, that's exactly what I've been doing. Like Harry Dent, same thing. Harry Dent, Peter Schiff, Mike Maloney, all those guys. I mean, fantastic in their own ways, but they're off on some of the areas, I think. So, and obviously they've got a clear agenda because they need to drive gold sales, and obviously they're going to be, pounding the table on gold and foreign stocks or whatever it might be. But what you need to see is like those ratios and really see the money flow. That's where I really now focus. Over the last couple of decades, I've really learned that money flow is probably one of the most important things. Unless the money is flowing in, like the fundamentals can be so fantastic, but unless the money's flowing in, and you can see the money flow using ratios, as you do, Andy. But unless you see the money flowing in, like you're just never going to catch a bid. It's not going to be going up. So that's really important. Yeah,
and I'm trying to think, like good thinkers too are super rare. Like to find people that can actually think ahead.
Yeah.
And that's all I focus on, is trying to think ahead. And then I just gave up on everyone else. I don't know what it was. And I just started doing it myself. Because once you do that, it almost frees yourself from everyone else's biases and opinions. And I like listening to others, but at some point, like I kind of stopped. I mean, I don't know. Do you still listen a lot to other people on YouTube? Like a whole bunch, or
not really? No, I hardly do actually. I don't really listen to. I just look at data.
That's all I do. That's it.
So I just try to block out a lot of noise now, just because I feel like, when someone's like talking and they're a good salesman or whatever, they can sound pretty convincing. So I just stay out of that. I just look at the ratios, I look at the data, I see, where the money's flowing myself using those monthly charts. So that's what I do. I don't really rely on anyone else to do the work for me.
And what do you like? What are some things that you think you did really wrong in the beginning when you were a new investor? Were you like what were you completely messing up? Were you messing up like your position sizing, your portfolio allocation, the wrong sectors? Were you just doing everything wrong? Like what do you think were your biggest mistakes?
Just getting married to a sector, I think. Obviously I've experienced the biggest gains in gold and silver, for example. So I kind of got married to the sector and I didn't want to let it go. That's when experience kicks in, right? So you've got to understand the flow of money. So when there are profits in the market, no matter how good the fundamentals, because fundamentals for gold and silver is still pretty strong, because Fed was printing money, like Peter Schiff is saying. We've got the highest level of debt. So fundamentals for gold and silver are very strong, but the money flows out, right? Once there's profit, once profit taking kicks into gear by big institutional money, that drives the prices down. That causes panic in the retail among retail investors, and that further drives the prices down. So it's all about money flow, in my opinion. So just getting married to the sector. I think another important thing is diversification. You don't want to be all in on one sector. I love uranium. I love, it's probably my favorite sector right now, but it doesn't mean I go all in on uranium. Like uranium is probably only like 40% of my total portfolio right now. So you don't want to be in one sector just because you just don't know. You never know what's going to happen, right? So uranium might be fantastic, but if there was like a nuclear accident, you don't know what it's going to do to the uranium thesis in the short to medium term. So you don't want to be in one sector. You don't want to get married to a single stock, just because it's giving you a lot of return. You need to be looking at all those things, have an exit plan in place, and execute the exit plan. Because it can be very easy to get caught up in the moment. Because I was like telling myself back in 2011, I'll probably take some profit, when silver hits its previous all-time high of 50. But when the sentiment is like crazy good and everyone's like talking about gold and silver and everyone's pounding the table that it's going to go up way higher than previous highs, then you get caught up in the moment and you don't really execute your exit plan, which is why I think it's really important to have an exit plan right now. And I do have exit plans for my all my holdings, including uranium stocks. So I think that's important.
Yeah, my exit plans have nothing to do with price targets at all. It has everything to do with market conditions and the movement of money ceasing to move again. Like the generator has stopped. So but mine's always been driven by that, not necessarily a price target. I don't know if yours is the same way, but
yeah, it's more along those lines. So I don't really have a price target right now. So it's a combination of time. So certain technical patterns, as well as I think we've talked about it before, which is money flowing out of these bigger miners. That will be a big warning sign for me, because that means smart money is exiting. So easy thing that any smart money or big institutional money can do is, because the spot market is usually a lot smaller than your miners, what they can do is drive up the spot prices while they are selling out of the miners. And that's what you see when you see the ratios between the bigger miners and the spot prices of commodities start favoring the spot prices rather than the shares itself, then that's when you need to kind of start thinking about getting out, because you know that the institutional money is pulling out of the sector.
And what about like going into large cap companies, mid cap companies, and junior companies? Did you pick that up pretty well when you were a new investor, or did you take on too much risk? Like what did you do wrong there, or what did you do right there?
I think I always had a combination. So right now I've got a combination of, smaller explorers for uranium anyway, for smaller explorers, mid caps, as well as producers. So I always like kind of splitting it out, 1/3 each. So, my holdings, for example, it's 1/3 producer, 1/3 mid cap, 1/3 explorer. But that's just a rule that I've kind of set for myself, because I just don't want to be an all-in explorer just to manage risk. Because obviously if there was a short-term downturn in the markets, for example, explorers will be diluting very heavily, whereas the producers, for example, might be able to sustain for a little bit longer. They've got bigger market caps, so same amount of money raised for the producers with bigger market caps will mean less dilution in the medium term. So yeah, I've kind of got it just like split across the producers, mid caps, and explorers, and that will probably be that will be my approach going forward as well for any commodities.
Yeah, I'm trying to think of exactly what I would tell myself, how I would play this. I think what I would tell myself is probably the most valuable is it's not about the risk reward per se. It's not about the ultimate return. It's about the reliability. It's about the probability of getting great returns. So
yes,
it's and a lot of people, they want to like jump in these really small gold and silver companies or something like that, and it's like, man, the probability here isn't that high. But if I chose a oil company that was really low, the probability, if you look at those, is so high for them to go up that it's and that's how I played it this time around. Is I chose a lot more oil and natural gas companies than I did in any other sector. And I even think the probability of success in oil and gas is probably higher than uranium. Uranium has higher returns, though, could potentially have higher returns. So it's like if I were to tell myself again, favor the probability of the return happening versus favoring the potential max outcome. Because if the outcome doesn't come, at least you have a massive leverage bet that wins. Like that's a high probability chance versus a whole bunch of money that's stuck in stuff that has like, you know, there could be so many duds and it just doesn't work out that way. I didn't necessarily in the past go after all the explorers, but I know a lot of people who talk, whenever they give me companies, a lot of them are like exploration companies. And it's like, man, this thing's a long shot. Like you can't put, if you're running a $100,000 portfolio or even a $10,000 portfolio, it doesn't matter what the price, you know, the number is. You can't put 50 or 60 or 70% of your portfolio in junior mining companies because you think that taking on the risk is going to get you that big reward. And I just don't think that's a smart way. I'd rather, if you're young, I'd rather compound money more over with, for sure, you know, higher probability bets than taking these ones that are like, let's roll the dice and fling it on the table. Like I just, that's what I would tell myself. And getting a mentor is like massive, like, cause it'll speed up your progression so fast that it's like cheating. It really is.
I think so.
And I wish, I mean, I'm trying to get, you know, some stuff from some other people. I'm trying to learn from others, whatever I can learn. And it's getting harder and harder to learn more because I start listening to other people and I just don't believe that they know what they're doing. Like you get to a point where you're like, you start questioning. And how do you, you know, how do you know that? Like, how do you know the information you're getting from some of these people is actually good information? Like how would someone new know that? I mean, you could get duped so easily, and I feel bad for him, you know, like I don't want, I mean, I got duped on a lot of stuff. Like I missed a lot of opportunities because I didn't know what I was doing and who I was listening to. Because some of these guys are perma bulls in gold and silver. They are perma bulls in certain sectors, and they'll tell you don't go into tech, even though the best time to go into tech was in 2009. That would have been just an absolute killing. And my problem was I listened to those guys too long, and there is cycles and they are identifiable, and housing market. And I've had people, I've tried to bounce my ideas off other people and they just tell me I'm wrong. I'm like, okay. I mean, obviously you haven't looked at the data yet, but like I've talked, and I don't want to bring up their names, but I've talked to some of these big people that you've mentioned. Some of them work with Mike Maloney and some of these other people that they show. That's when I just veered off. I was like, I'm out of here. And I just don't know how you could, if you're a new investor, I don't know how you could identify that. You'd be like almost listening to some of these people wholeheartedly, and you'd be going down the total silver
with
path.
some of the bigger names. I think with some of the bigger names, obviously you can do due diligence because, you know, there will be heaps of materials available on YouTube dating back to, you know, 10 years or 12 years or whatever it might be. So I think you can definitely go in and listen to what they were saying back then and see if it's played out as they were saying, because I think what you'll find is that a lot of them are perma bulls or perma bays in certain sectors. And their opinions, like if you look at a lot of these bigger names, like their opinions haven't changed at all in the last decade or two. They're bullish the same sector, they're bearish the same sector. So I feel like you can obviously do your due diligence that way. And I think just logical thinking, you know, like I think you've just got to apply logical thinking, because obviously we all have, you know, brains and we can obviously think for ourselves. So just think about whether what they're saying actually makes any sense. And study charts. I think starting the charts is really important, just because like I used to be a huge fundamentalist when I first started investing, because I got into Benjamin Graham's book and everything else. But over time, I've learned that technical analysis is actually probably more important if you want to make money than fundamental analysis. So obviously they go hand in hand and they need to support each other. But if I had to pick one, pick one out of fundamental analysis and technical analysis, I'll probably pick out technical analysis.
Why is that? I mean, everyone hates the technical analysis approach. And I'm going to just say this. the markets made me who I am and why I chose technical analysis over doing a lot of the fundamentals. And it wasn't me choosing it because one was easier than the other. It wasn't me choosing it because of my own self-interest. It was the market telling me and my returns telling me that I have to choose this and I have to get better at it. I mean, that's what, and then it morphed into more of that because I mean, it's weird. I am a product of the market. That's really what I am. Taylor Swift, as weird as this sounds, Taylor Swift, I listened to something of her and she's like what she said was very smart. She said, she was like really, I don't know, she was like crying or something happened. And she's like, I don't know why these people are wrecking me. I am a person or a product of exactly who they wanted me to be. And I was like, that's actually really smart, because like you become famous because of the things that you do that everybody wants you to do. So she became what everyone wanted her to become. And I was like, well, that's exactly what happened to me in the markets. I became exactly what the markets rewarded me to do. I mean, and that's what it came down to. And the only way that I could do it is I just ask questions about money flows and stuff like that. And then it would lead you down certain paths. And then I would ask the question, well, how do you verify it? How do you validate it? How do you get all these questions? So I do think like an engineer could come in here and just rip things apart, or anyone who's like somewhat analytical and can rip through data would do very well as an investor, no matter what background.
I think so.
Would you agree with that?
Yeah, definitely. It's just, so, collecting a bunch of data and just, using historical data to make forecasts, right? As to what's going to happen.
But I mean, obviously you think about things too. You think, well, what is a leading indicator to show us that something like a recession could come? And how could you monitor it or verify or validate, however you want to use, whatever term you use, to ensure that you are getting that information before everyone else? And another thing that I think that a majority of people do, and I never did this, but a lot of people do it, is they make predictions. Why? I'm not in the predictions game. I'm in the probabilities game, and chart reading is a probability. But when you look at data, it's like the data posts, and then I look for the trend. And it's just like, is this going to go up or down? Well, the trend is up. I'm going to stick with the trend until it changes. Everyone else is like trying to predict when a top will be. And I'm like, why would you predict? You don't have to. You just wait till the trend ends and then you get out. I mean, I don't. New investors, I mean, I think it's very difficult because you've got all these people who are perceived financial experts telling everyone that the housing market's going to crash. And then they give predictions like, oh man, the mortgage rate's going higher. That's just going to absolutely kill the housing market. Well, I'm like, has it killed the housing market? Do we have increasing inventory? Have we? So I mean, I am like, how can I say it? When I look at some of these things, I'm almost like the solo thinker when everyone else is just blah, 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 blah. Mortgage rates going up. We're going to crash absolutely everything. Blah, 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 blah. And it's like, how can they crash when you need what, 4 million more you need 4 million homes in inventory, more than what you have today, for this thing to even crash out, to be in a bubble. And that's with no one buying. So I'm like, how is that going to, I don't know. I
think just look at data, right? Because hold on, let me just share my screen with you.
You have to accurately analyze the data though.
Yeah, that's right. But you just have to look at data in that. So if you worry about housing crash, an immediate housing crash, let's go back to just the last housing crash of 2008. So Fed first started raising interest rate in 2004. And when did the biggest run in the housing market come for the US? When were like CNBC and Bloomberg and CNN like touting how great the housing market was?
I think it was like 06, 07, and maybe even 08.
Yeah.
Even though 08 was kind of stale as heck.
Yeah, so that's exactly right. So it takes time. Like you just have to look back to history and see what's happened in history. And yeah, usually what happens is the biggest runs and the blow off tops usually come right before a crash. So if you're trying to predict the crash 2, 3, 4 years out, then you are potentially losing the biggest and the fattest portion of the bull market. So I feel like that's a pretty dangerous move if you wanna be compounding your returns.
Yeah, so being out early is actually it's rough because some of them, like I think it was Chesapeake Energy back. I mean, this was pre-bankruptcy because they went bankrupt and had to do whatever. Can you see a chart that's back in like the mid 2000s on Chesapeake Energy?
I don't think so.
Because I'm gonna actually look real quick because that was one company that I thought was pretty sweet. Chesapeake.
Okay, while you're looking that up, this is when the housing crash was, obviously. This Peter Schiff was right video. It went viral in 2008 when he was calling for a housing crash since I think 2002 or something, right? So this video suggests that he was calling for a housing crash since 2002, and he was finally right in 2008. But what you don't see here is that if you've listened to him since 2002, you would have missed out on the entire bull run in housing.
Yep.
And what you could have done instead is just look at the delinquency rates. What you could have done is just look at the delinquency rates. Oops. Mortgages. Look at, as you said, look at the trend change in delinquency rate. And if you see a clear change in delinquency rate, you could have got out here. So you could have ridden like the whole bull market.
Yep. And then when it starts to go up
in 2004, yeah,
you pop out in 07.
That's right. That's right. Sorry, did you want to share something?
Yeah, I will. I'm gonna try to get. Let me see if I can find one last one here. I found Chesapeake Energy's. It's a come on.
Okay.
Daily. I can't find Ultra Petroleums in the mid 2000s, but I'll show you this one here.
Yeah.
So this is the. Oops. This is Chesapeake Energy back in. This is the 95, 98. It went all the way back down to like.
Yeah.
This was literally like less than $1. And then it started going. You have to ride through this stuff here in the mid 2000s. You got a nice good little pattern here. It broke and it was like, see ya, wouldn't want to be ya. So this pattern hit $5 and went to 35 in like a couple years. It was like bam.
Yeah.
Then we went sideways for a little bit, and this pattern is like you see it everywhere. You get this like leg, you get a sideways, you go to a peak top, and then you go back down all the way again, and then this pattern repeats over and over. But
yes,
this pattern's the same pattern here, this whole little pattern here. But I mean, I had a bunch of problems in this. I was like trading in and out, and I got all messed up, and then this thing just came and blew. But even if like here you're at like 20 something bucks, $25 down here, and it went straight to like 58 in a heartbeat. It was like, oh my goodness, it just shot higher. But if you could, the one thing I learned in the last bull market, it's like, don't worry about all these little moves. Like get in early in 98, 99, 98, get in like heck in here. You buy the living poop out of it, like the shipping companies are today. And then you just ride it on up. And then if you want to sell in here, or if you can try to time the top, I mean, this here is a massive run. You're talking like 60 cents to $60. I mean, that's a 100 bagger. That's a 100 bagger.
100 bagger.
It's a 100 bagger. In what is that? 99 to 2008, in 9 years, you have 100 times your money. And you can't worry. You're going to have to ride through all this garbage.
Yes. Yes.
And
that's the only way. That's the only way. You can't time it. It's impossible. Like no matter how good of a technician you are, like you're gonna be missing out
Well, once
if you
it
try to
left,
time these trades.
once it left in the mid 2000s, it never really pulled back. So
Yeah,
once it broke here, you're like, oh, I'm going to get in. Oh, wait for the pullback. It's like, what pullback are you getting? And then you're up in, I mean, you went from $5 to 20 something bucks with no pullback.
yeah,
And you're like, what are you going to do?
35.
Buy it up here? I
Yeah,
mean,
that's right. You
you're
can't.
conflicted. And then you've got, the pause point was the last high back here. And then it
Yeah.
just rocketed higher again. So,
Yes.
yeah, I stay in and I'm not trading this market at all. And I think that we are like over here. That's where I think we're somewhere in this region. And I don't think we've even done this on that side. So, and the reason I think that is
Yeah.
where we are in the housing starts. We haven't built anything. We haven't made any headway against the deficit. We did some, so I had a guy at work, he did some calculations just because he wanted to, and he was sharing them with me. And the calculations were, how many homes do we have to build for the millennials that are coming to stay flat, like to not increase inventory and not draw from inventory? It's 1.8 million.
Yeah.
So we have to go above 1.8 million to go against the deficit. And I'm just like looking at this like, well, we can figure this out. If all you need is some math, you throw it in Excel, you get the math, and then you calculate it, and it's like, this isn't, that hard to calculate. So anyone who's saying we are in a housing bubble, I don't think understands the demographics. Now, my question that I ask for a lot of people is, in the 1970s, maybe interest rates wasn't the thing that pricked inflation. Maybe it was the demographic running out. And if that was the case, then this inflation that's new may last 10 years and nothing's going to have it go away. The housing market's going to remain resilient. You have a floor of people that if they can't buy in the market today, there's this big floor underneath it that the market can't fall. So it can go up, but it'll get sticky and it can't fall because people will continue to just pick these homes off if they think that something's going to come back. And if interest rates go back down, there are going to be more people coming in that are more qualified buyers. So it's a.
I mean, during the 1970s, there was no housing crash, right? Like at least in Australia, like I know Australia had like huge interest rates, like same as America, like 20% mortgage rates, but then there was no crash in Australian housing.
We had a crash in housing.
But obviously homes were a lot cheaper in Australia relative to, income, at least in Australia. But just because we raised rates, we didn't see a huge fall in the housing market at all. It actually rose quite a bit.
Well, house prices going up and increasing interest rates go up in tandem together because interest rates chase inflation and bondholders don't want to hold during an inflationary period. Inflation's coming from the housing market in history, not from stimulus because they didn't have stimulus. So I think the same market conditions exist, and I don't know how rates are going to go down unless they step in and just buy the living poop out of it. But by them doing that, by buying bonds, they would be amplifying the inflation and the risk in the system. So I don't know.
So what that's doing is, if Fed steps in to buy the bonds, then effectively what you're doing is you're giving institutional investors and other foreign bondholders an opportunity to sell your bonds at a good price, which means they've got more money to rotate into general equities, real estate, and commodities. So Fed is basically fueling all of that.
I don't know what they're doing. So going back to a new investor, what are some other things that you could tell about or tell a new investor that they should be learning or inquiring about, or outside of just going to the
reading as many books as possible? I think outside finding value, I think mentor is probably the best thing, right? Because if you can just ask the questions on the spot, like that would be the best thing. And if you can kind of like, if they can hold your hands along the way, like especially during volatile times, because you're with any commodities, it's going to be volatile. Like shipping, it's going to be volatile. Anything's going to be volatile, right? So if you need a bit of hand holding, obviously finding that mentor will definitely help you do that. But otherwise, I've learned a lot from just reading books. So I've probably read, I don't know, maybe 20, 30, 40 books on investments and trading and things like that. So just reading as many books as possible, because obviously that's how you draw the most amount of information in the shortest period of time. So that's when you can learn from someone else's mistake rather than your own. So just reading books. I think trading books are probably really important. Just technical analysis. Maybe you don't even need books, because there's just so much information on the internet right now. And TradingView is a free charting platform where you can just play with your charts and just look for patterns. Look for certain patterns play out. Look at as many charts as you can. Thousands of charts. Andy, yourself, and I, we probably looked at thousands, if not millions of charts. So just looking at charts and learning from what happened historically when certain movements appeared on charts. So just learning from that, I think.
What about like is there any software or certain things that people should buy or get if they're new investors, or any brokerage accounts that you think they should look into that you like better than others? Anything there? Because some people ask me about that every once in a while.
No, not really. Not really.
So
Not that
just
I can think of.
TradingView for technical analysis charts.
Yeah.
And
all
most
I
of it's
use.
free on TradingView. Yep.
Yes, that's right. Yeah.
So yeah, and then the brokerage accounts doesn't necessarily matter. I think you can choose basically anything and be okay.
I think it's good to go with a well-known broker, obviously, because a couple of times I've heard of horror cases where a broker went bankrupt and people couldn't recover their money or whatever. So it's best to go with your some of the biggest banks in your country, or some of the most well-known like international brokers like IBKR or whatever, because last thing you want is the broker to go blow up and you're left with nothing.
Yep. What else? Is there anything else that you would want to tell a new investor or someone who's trying to learn? Like what? Got nothing else?
No, trend is your friend.
Yeah,
go with the
don't
trend.
fight it.
As Andy was saying, just don't try to predict the end of the game, because usually what happens in any bull market is you usually end with a blow off top. So if you haven't seen blow off top in the sector you're in, it's very unlikely that the bull market's ended for that sector. So I would, look for a parabolic run. I would only start thinking about an exit plan if I do see a parabolic run on a weekly time frame or a monthly time frame. So yeah, trend is your friend. Don't try to predict, go with the flow.
A parabolic run, like what does a parabolic run look like? Are you saying like it doubles very quickly, like right at the end?
Yeah, I mean, it's just visible on the chart, I would say. So I don't think there's like a hard rule in terms of the number, because every chart has different fractal, right? So a classic example is obviously BTC, Bitcoin. It will be very visible. You'll be breaking out of these linear moves. So if I just draw a line here and say that was a pretty clean parallel channel, for example, and it broke out of that, and you probably have like good 6 months. I always talk about the 5 to 8 months when they can continue to go parabolic. So you can see here, it broke out of this parallel channel, and it goes 1, 2, 3, 4, 5, 6 months. So if you're in a parabolic run, if you had a clear uptrend, a parallel channel that kind of it was stuck in, and suddenly it goes parabolic, then you need to kind of start thinking about getting out. I would say, as a general rule of thumb, and as I see it in a lot of charts, 5 to 8 months after it goes parabolic is when you want to probably start thinking about it. And I think this happened to many, or Chemico as well. So right now, as you can see, this is a pretty clean parallel channel. Maybe not parallel, but this is a pretty linear upward trend. So you haven't seen the parabolic move yet, and I think it's coming. But what you see here is, once again, this is a linear trend for Chemico back in the 2000s run. So you can see the linear trend, and then it breaks out to the upside, and then you'll probably see 6 to 8 months. And this is the two legs that I think is coming for uranium, right? So you see, this is the breakout. This is probably the breakout by 1, 2, 3, 4, 5, 6, 7. So yeah, as a general rule of thumb, 5 to 8 months after it breaks out of the clean parallel channel. And once it starts going parabolic, and it's just visible, right? So if you look at a chart and if you just see this going parabolic, like just really vertically upwards, then that that you're in a parabolic move. Yeah, just count the periods. I think the best thing to do from when it goes parabolic is just to count the period that they go up for, and then start thinking about the exit plan that way. But yeah, you want to be waiting. You want to be in it for the parabolic move, is what I'm trying to say. And you want to ride it for a decent portion of the parabolic move, because you don't want to get out too early. If you get out now, if you get out of uranium, if you get shaken out, you're effectively getting shaken out like here, before anything's gone parabolic. Like it hasn't gone parabolic at all. If you look at this,
and the explorers are way worse. They haven't gone anywhere.
Orderly. Yeah, that's right. You look at like even Pure Point, which I don't have. Like they've done nothing. They've done nothing for, what is it? From 2011. They've done nothing for a decade. You can't really call this an exit point. You can't say uranium market's dumb and it hasn't done anything for the last 10 years. So yeah.
Agreed.
Look for a parabolic move. Look, I mean, this is the type of move that you want to be looking out for. It will just go parabolic.
Man, that thing went super late too. It was like boom, 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 done.
Yeah, that's it. That's what you see with a lot of the smaller plays, because they just tend to play a massive catch up towards the end of the bull cycle, like Mega Uranium, for example.
I like Mega.
Once again, like it's just gone parabolic from this point. Like you can kind of you can't draw a line because there's no historical data, but you can see that it's going parabolic. Like we don't really need to draw any trend lines to say this has gone parabolic. It's very obvious to a naked eye that it's just going parabolic. So yeah, just look for those look for these patterns. I think parabolic move expected to have maybe 2 legs up, 2 really strong legs up, 5 to 8 months in length each leg up, and think about exit plans then.
That makes sense. Is there anything else you want to share with the new investor crew now?
So.
I don't think so either.
No. I think sign up with Andy. I think that's probably the best tip. Like, I mean, even if it's not Andy, find a tutor that can really educate you and be with you on the journey together. Well, like it doesn't have to be Andy, but if you can find someone like that's good and reliable, then yeah, I think that's probably the best.
How do you know they're good and reliable if you're new? Like that's the difficult part. How do you know
your due diligence?
How do you know?
I would. Yeah.
What about a financial planner, like a regular financial planner? Do you think they would be good?
No, because there's no historical data available. Like the reason why I would probably go with you, Andy, and I feel safe talking about you is because I know what you've been posting on your YouTube channel like 2 years back or 1.5 years back. So you know their record. So I think it's really just important to do your own due diligence when you're selecting someone that you're putting as a mentor or tutor, that you do your own due diligence as to how good the tutor might be, right? Because you don't want to find a dud tutor that talks about, that sounds smart, but you go back to like the videos 2 years before and like they've had everything wrong. So do your own due diligence, basically. Yeah.
So here's something. So someone goes and they go to their financial advisor or something like that, or they have some financial advisor. They were to look at the portfolio that I have, they would say, this guy is crazy. He's in commodities. He's heavily loaded in uranium, oil and natural gas. He's got a bunch of, some precious metals companies and royalty companies and stuff. This dude is like obviously not as diversified as someone else. This guy is crazy. Like, how would you respond to that if your financial advisor is telling you that with the portfolio that you're putting together?
I think you have to do your due diligence on the spot. Like keep asking the question why. Like, what is your reason? What is your fundamental basis? And what is telling you that this isn't time for commodities? And if you get stuck, then obviously you've caught him out, right, on the spot there. So you've just got to be asking questions. You've got to be like an auditor, right, for yourself. You've got to do your own due diligence, and it's just so important. Like even like just as much as it's important to like invest in the right, companies and things like that. Like it's, if you are new to investment, if you're trying to rely on a guy, it's just so important to do due diligence on the person that you're trying to rely on. So do your due diligence.
Here's the tough part though. If you're a new investor, you usually look at price as a justification of something. If you're a very experienced investor that's going after huge returns in very short periods of time, you're going to be doing opposite of everyone else. And then everyone else is going to be calling you crazy. So you almost have to get used to being called crazy all the time, and that your picks are bad, and that they'll never work out, and that oil's never going above $40 again. And all these other people telling you that that's just, it's hoopla and it's not going to work. I mean, do you experience those same type of things when you're buying the companies that you're buying?
For like shipping, we've had some very negative comments on shipping recently.
Is there?
Yeah, I mean, yeah, that's kind of expected. But I feel like it's not too hard of a sell when you're trying to, tell people that maybe oil is a good thing to look into, or uranium is a good thing to look into, because the ship has started turning around. So it's turned, and you're seeing money flow into these sectors. So I don't think it will be too much of a hard sell. But yeah, but no, I think just judge for yourself. I mean, once again, just applying logical thinking, what makes sense, and just think about the bigger picture, because the thing that really is really important to remember is the dynamics of the three biggest markets, right? So the bond market, the general equities market. If we neglect real estate for the time being, bonds, general equities, and commodities. And if you think about it, just think about it logically, right? Because right now, most people are invested in bonds through their superannuation fund or IRA accounts or whatever it might be. Most people are invested in tech through either their normal brokerage account or whatever, or IRA accounts. We call it superannuation here. So you won't see anyone without those holdings, right? So now, like if there are maybe 5% of the people left to go into these sectors, like you're not going to be driving up prices. But let's say only 3% or 2% of the total population are holding commodities right now. Like it's very natural for money to come out of these sectors where everyone's like very heavily invested in, to flow into commodities. It can't go the other way around. So just thinking about those money flows logically, like just apply logical thinking, and look at the markets more broadly. Don't focus on individual companies. The starting point should be, okay, where is the money right now? Where is it very heavily concentrated in? Okay, well then, if there's no one left to go into these sectors, then the only way for these sectors is down or stagnant. So look for something that's undervalued when no one's participating in, that money can flow into, which are commodities right now. And that's the sector that you want to be in. So just, logical thinking.
Making it look easy. Making it look easy.
Yeah.
So I mean, that's, I'm just trying to think of stuff for new investors all the time. And, a lot of people, they'll look at probably, I mean, if you looked at my portfolio, it's kind of actually insane what I've done over the past 3, 4, or 5 years. I did turn I turned my wife's portfolio. She had a 401k. It was like $30,000. I turned it into just shy of 200,000 in like 3 years. And like, everybody's like, no way, there's no way that you could do it. And I added no money. I added zero money to it. And they're like, yeah, right, there's no way. I'm like, yeah, got it right here.
Yeah.
So that's a pretty good one there too. And when you start talking about the returns, it's like, but you can't do that. I don't know if you can do that if you're a brand new investor, because you think that new investors always want to move. They want to chase. They want to move things all over the place. It's like, that's not what I did. I just bought companies down low, and I'm just riding. I'm still riding it. And the ones that I own are uranium, oil, are my major holdings in that portfolio. I overweighted SM Energy. That was my trick.
Sitting tight is just so important. It's probably the toughest skill to learn, right? Just being able to sit tight, because obviously as a new investor, you always feel, and that's exactly what I did when I first started investing. I was probably trading like at least a couple of times a week, in and out. Yeah, you don't want to do that. You're throwing away a lot of money on brokerage fees, first of all. and you're gonna miss out on the biggest moves. Like when stuff goes parabolic, you'll be out of the trade completely, and you'll miss out on the biggest and most profitable portion of the bull run. So yeah, just don't trade in and out.
That's right after it breaks like a major point. You'll get this big kind of intermediate run, like a massive one, and then you're gonna get a blow off top.
Yeah,
so
that's right.
All right, well, we'll end it there. We've been at it for a little while. So again, Scott, you probably have something that you want to share with everybody, maybe. Obviously, thanks for coming on to the channel. And everyone, don't forget to subscribe to Sow and Reap Capital. We can get that channel. It's a growing one.
Okay, great. Thank you. Yeah, I just wanted to share Matthew 19:26. And basically it says, with God, all things are possible. So yeah, just I don't think I need to explain that further. Yeah, God is the creator of earth and heaven. And yeah, he can do anything and everything. And that's it. Thank you.
All right, we'll end it there. Thanks for coming on, Scott. Really appreciate it. And we'll see.
Thanks for having me, Andy.
Everyone and Scott next time.
All right. See you, everyone. See ya.